What's going on, beautiful people? Daniel Madyar in the building with another topic today. And today I'm going to tell you why you're broke. Literally in 7 steps. And this is going to be a very beneficial video. I wish I had this information long ago, because I stuck to it, but kinda when I was too young, because I couldn't really understand the real benefit of compound interest. Now I'm 12 years in, and usually they say it takes about a decade for you to see the results when the compound interest actually kicks in. And of course, elderly, more experienced people couldn't be more right. Now when I look back on my portfolio, I'm like, holy shit. Okay, so the first decade, yeah, it feels like it's not going anywhere. But after that, when the interest just keeps kicking in and you stay consistent and disciplined, keep putting money in the investments, you're actually going to start benefiting big time, and you start believing in the investments, just like Charlie Munger said, Warren Buffett, and the elderly wise guys. So in 7 steps today, we're going to talk about why are people broke. And before I start, of course, you can find my services at dmprotrainer.com. You'll find the link below the video in the description. You can book a single consultation, or you can join my coaching program, 1, 3, and 6 months, that's focused on fitness, finances, and human relationships. Also, I published a book called Weight Loss Without Plateau, where I describe the metabolism in detail. And I also give you all of my experiences in terms of calorie cycling, described and explained in the book, in case you want to build your own meal plan. If you guys want to order a really high quality beef that is grass-fed, grass-finished, I own my own beef company. We produce beef in Utah and Texas, and we ship nationwide. So you can get a really good high quality beef that's American produced right into your door. Now, okay, let's get into these 7 steps. I did a screen right behind the camera, so I'm just gonna read a point off of that, and then I'm gonna explain in a detail, just like I always do. So the step number 1 is instant gratification bias. Human brains are wired for present reward over future gain. Temporal discounting, spending today's feels certain, investing feels abstract. This makes consumption emotionally easier than compounding. In a simple words, what this means is that giving yourself something as a reward right now, first of all, it goes along with the nature of your brain. When you were working so hard, you want to reward yourself with the luxurious bag, with the luxurious dinner, whatever it might be. First of all, it starts with the small stuff. So you start spending 100, 200 bucks here and there for your personal rewards because it feels safe. It feels certain. When you spend the money for your own pleasure, it's certain that you're going to experience pleasure. However, when you invest in the future, you don't really know how it's going to go. And also, you've been told by the society that investing is bad, it is risky, etc. Listen, you are your own biggest risk. Inflation, oh, dude, forget about inflation. You are much worse than inflation to yourself with your behavior. Reward and mindset will eat up all of your money, where inflation might eat up a couple percent. So before the inflation even applies to you, you're far from that. Okay, it's when you actually have the net worth and you want to protect it in the long run. So that's why you diversify, you buy some tips and bonds, etc., that protects the money. You buy some precious metals like gold and silver. There's plenty of investments that you can make to protect the money from the inflation. But the inflation in the beginning stages doesn't even play any role. It's like it doesn't even exist. What's the point of inflation when you got spare $500 and you spend it for instant pleasure? That's where I see a lot of people go wrong. They worry about the wrong stuff. Like, your problem is not the inflation. Your problem is the mindset. So you actually have to believe in the future compounding in order to fix your issue of being broke. And you have to stop paying for instant gratification or pleasure. This is the biggest thing that I see. Okay, now the step number 2 is lifestyle inflation feedback loop. Now, lifestyle inflation is completely different from the economical inflation. Let's get into that. As income rises, spending rises to match it. Instead of directing surplus towards assets, people normalize higher expenses, eliminating the surplus that builds the wealth. That means that as soon as you get a chance of make more money, let's say you get promoted or your business is taking off and is doing better, people always increase their lifestyle along with the income. Again, you're just a broke person with better experiences, a broke person in a nicer car, a broke person who eats at the nicer restaurants than Chick-fil-A or whatever. So the point is not to increase the lifestyle all the time. Again, that goes back to the previous point, the gratification bias and the reward system of your brain. You make more money, you feel like you deserve more. At some point, you'll get in a situation of your life where you got your house or an apartment, doesn't matter, whatever you need. So you got your residence, you got your car, both paid off, dude, you're good. That's already really high luxury lifestyle. Most people cannot even pay off their mortgage. So when you get to a point where you own your own real estate, you live in it, you own your own car, it's paid off, stop there. Just increase the income and limit the expenses, and everything that happens between the income and the expenses is your future. That's your future net worth, and you push it into the investments. Now, what I like, really, I've had a lot of physical real estate, etc. I don't like it. I don't want it. I much rather buy Vanguard products like VNQ, which invests in a real estate for you, and you don't have to deal with the hassle of tenants, etc. Rewards, literally the same, if not better, with no headache. So I stopped buying physical real estate, and I just literally invest into the real estate market through my broker. And I just keep investing all of the differences between my income and the expenses into the future compounding. So if you're really new to investing and you know nothing about it, you'll be better off just buying simple S&P 500 regardless of the price than spending it elsewhere. The S&P eventually you're going to get some highs, some lows, some highs, some lows, and then it's going to even out, and over let's say 2 or 3 decades, you're going to be at about 10% of compound interest historically for the past 100 years, okay? So that's when you don't really know what to do and how to be an investor. But being an investor is really not about intelligence. It's more about discipline and emotional regulation. We're going to get into that later in these points. However, the lifestyle inflation is what kills people. I see it all the time, especially in the modern world because of Instagram, Facebook, etc. You guys are looking up to people who are spending money. It doesn't make sense. A wealth is not built by spending the money. But you go on Instagram, you see the guy in the luxurious cars, you see them always in the Komodo restaurants, 2-3 grand a bill every single night. They live in a luxurious house. These guys are broke. I'm telling you, they're broke as hell. They don't have any investment portfolios. They maybe had a good run, and they're just spending all the money from that good run so they can maintain the internet presence, so because their identity is attached to that luxurious lifestyle. So as soon as they stop living the luxurious lifestyle, they're gonna actually face the collapse of their own identity because they don't even know who they are without that lifestyle. And they, of course, don't wanna lose the public image. So they just keep financing this lifestyle that is destructive. These people don't have a lot of money, trust me. Stop looking up to people who are spending money. Start looking up to people who are investing money. You can actually invest all of your money through your phone. That's where I was really confused when I was beginner investor. Like I started in 2015, 11 years ago. I thought it's a special process only for certain people, and you have to walk into the skyscraper and broker sounded somebody like who's wearing a suit, like freaking 60-year-old guy who knows everything about the investing, and I have to be prepared and understand the terminology, and investing works through like a round table. I had no idea what the hell it means. Dude, investing is literally happening on your phone. You download the app, you transfer the money to the app, that's your broker, and then in that app you purchase whatever you believe is going to be here for the next 30 years in the market. You do it literally on your phone, okay? To me, when I didn't know how simple this is and how accessible it is to the public, it sounded ridiculous. Like investing is just not for me, but it actually is. So once when you understand that, you actually understand that building wealth also applies to you for a simple guy, a simple citizen like myself. And I can just keep building my wealth from my household, and then I just build a system that is going to pay me before I pay anybody else, just like the richest man in Babylon said. So let's say you get $1,000, you pay yourself $100. instantly, and then you got 900 bucks for spare. You can pay the bills, etc. But that 100 bucks that you just paid to yourself goes instantly into the money market when there's no opportunity, or instantly into the opportunity where you see some. Right now, we got Adobe pretty low, sitting at 240, big crash. Investors are afraid of AI. Now, Adobe started putting some AI systems into their softwares as well. They're undervalued. Their value is somewhere between 400 to 450. It was even at 600s before. So pretty much it's a good opportunity to step in. So you take your 100 bucks and you buy some Adobe right now. You let it sit there forever. You don't worry about it. I personally don't ever sell my investments. So that's why I only buy things that I believe are going to be here forever. ETFs, bonds, and tips. Very safe investments first. And then, for example, like singular companies like Adobe, I put some money in there too. So you look for the opportunities. So we got a little bit, a sidetracked, but we said what had to be said. Lifestyle inflation, that's where most people fall on their face, and that's what prohibits them from getting richer. Now, step number 3 is loss aversion paralysis. Psychologically, losses hurt about twice as much as gains feel good. This leads people to avoid investing, sell investments too early, hold cash excessively. All 3 suppress long-term compounding. Okay. Avoid investing. Why? Because you've been told it's risky. You are your own risk. Trust me. There's not a chance in the world that the $100 you're going to spend at Olive Garden is ever going to be back. It's gone forever. And there's not a chance that you put 100 bucks in S&P 500, just at a simple index that you can do right on your phone, and the same 100 bucks is going to be just as gone forever as it is by spending it at Olive Garden. No, it doesn't work like that. At S&P 500, it's going to have ups and downs and ups and downs and ups and downs. And historically, it's going to compound at about 10% interest if you let it sit there for decades. So do you understand finally? Like, the investing is risky. That's what you've been told. But when you take finances into your own hands, you just put the money to literally a freaking black hole that is going to drain all of your account, and that money is forever gone. So what is actually risky? Your own behavior or the investing on its own? In a worst possible scenario, if you buy some shitty stock and 100 bucks turns into the 10 bucks, you still have more money than spending it in Olive Garden. In Olive Garden, it's gone. You ate it. In a shitty stock, it's still 10 bucks. It's like a worst miserable case. Does that make sense? So sell investments too early, people panic. Like if the stock doesn't go or if the bond doesn't go the direction they want it to, they're not thinking long-term, they're thinking short-term, so they sell it instantly. No, it's actually, you got to listen to elderly wise people. You don't ever sell. That's literally how I look at it. Or hold cash excessively. That's more for the people with the high income. But that's when the inflation, actually applies to you, etc. Now, the step number 4 is short-term thinking culture. Most people evaluate money decisions using months, while wealth builders think in decades. Incredibly important. Compounding is invisible in the short term. So impatience kills strategies that actually work. Human brain wants always instant rewards. That's why you have day traders, option traders, contract traders, etc. None of these traders ever made money long run. I know, you have a friend who made, he made money. Yeah, I know he made money. Tell me something I haven't heard before. What happens is there's going to be a trade that's going to wipe your entire account. But I know your friend has a stop loss, you're using the stop loss, you're safe, you know what you're doing. I've heard it all. Nobody made it in the long run in these leverage type of deals, ever. Eventually you're going to get in a gamble mindset and you blow it all away. It's no different than a casino. So you really want to think long term. You got to go against your own brain and be strategic and smart. Long term is boring. You don't see a crazy spikes of your money instantly. However, that's what I was told by much richer people than I was back in 2015. First decade, it's boring as hell. Don't expect anything big. Now I'm 11 years in, and when I see the compound, I could retire for the next 20 lives. Why? Because first of all, my income was really high for a long time. But the difference between the high income and my low expenses, I was constantly investing. So that's how I was able to get to millions of dollars in terms of the investments. And when I see this compounding, now I finally understand what I couldn't understand when I didn't have this money. These people are actually right. For the first 10 years, it doesn't seem like you're going anywhere. But after the compounding will start hitting, it's insane what you can do in terms of the growth and also in terms of the dividend income, right? I mean, you could retire, I could retire right now literally just from a dividend income anywhere in the world I wanted to with a really high luxuriously standards. Just because I was disciplined, I kept believing it's gonna pay off. Just, I don't know, these rich people told me, and they were actually right. So you gotta think long term. Misunderstanding what wealth is a step number 5. Many equate wealth with visible status symbols. In reality, wealth assets that produce income, in reality, wealth is assets that produce income while you sleep. Status purchases reduce investable capital, the exact opposite of wealth behavior. Instagram, Facebook, TikTok, etc. People are looking up to people who are spending money. They're not teaching you how to make money. They're literally showing you how they blow all of the money they ever made. Here's how it works. Here comes an Instagram coach. He catches a really good algorithm. He's going to become worldwide known. Algorithm pushes him, millions of views, hundreds of thousands of likes, etc. He has a good run. Now, universally, everything that spikes quickly drops quickly. Always. This is just law of the universe. So when they spike quickly, they start making a lot of money with their coaching programs, etc. Which is pretty much 100% profit. Every coaching program. There's just the Wi-Fi expense, nothing else. So you get up there, you start making a lot of money, you have a really good run, and once when you start crashing, you still probably have some cash saved up, but you built your entire presence on spending the money and looking rich. So now you're trying to keep it up because you're hoping that the future business is going to bring you the same money as it used to during the spike. That's pretty much a trend business. During the trend, as you're viral, you're making a lot of money, but once when you start crashing, the money starts crashing with it. When you're not smart, you're blowing the money and you're assigning yourself to this really rich guy who's spending, I don't know, $5,000 a day just for bullshit, just restaurants and whatever. But here is the problem. When you stop doing it, you will show the world that you're becoming broke and YouTube channels will blow you up. Hey, this dude is not making money anymore. He's broke as hell. This was all just temporary run. And then you assign your own reality and your own identity to this kind of lifestyle, so you don't even know who you are without that lifestyle. So you're desperately trying to spend the money so you'll keep looking rich, and you hope that by looking rich, you're actually going to get more clients. This is a death trap. This is where everybody dies, every single influencer, etc. But people who don't understand it, they're looking up to these people who are driving, $3 million cars, etc. And they think they are having so much money they don't care. No, they have a problem. They spend $300,000 a month and they make $301,000 a month on the good months. And eventually the income starts draining and they will start spending the saving account just to keep up the lifestyle. That's a death trap. So when do you buy a nice car? Well, when you buy it cash and it doesn't affect you whatsoever. At some point I had 5 cars. None of them I ever drove and none of them ever affected my financial situation. I had a Rolls-Royce Corvette, a Cadillac Escalade, a Porsche, and a Ford F-150 and a couple motorcycles, Harley-Davidson, Blackout, etc. None of them ever affected my income, ever, all paid off cash. Then I found out it's the dumbest idea ever. That would be, I would say, my stupidest investment I ever made, 5 cars at once. I work from home. I put on like 200 or 300 miles a year on each car. The cars had drained batteries, constantly flat tires because they were just sitting full of dust. And I was choosing a car based on which car actually has a gas in a gas tank. So I get in a Rolls Royce, okay, there's no gas. I go in a Corvette, there's a little bit of gas, I'll take this one. Absolute nonsense. So I sold most of the cars and I kept the Rolls Royce, the F-150, so I can drive my dogs here and there. And I use it for Costco shopping, etc. And what I want to say is that never ever affected my money situation in terms of my investments or bank account balance. But then you'll have people who will literally buy a Rolls Royce on payments. That's suicide. Like, you don't belong to Rolls Royce world if you got to take payments on a Rolls Royce. Don't ever do it. It's going to become your worst nightmare. You're not going to enjoy that car. It's going to destroy you. So you just buy these things for cash And that's literally your pleasure and your reward for your hard work, because I came from freaking broke Eastern European country, broke myself the entire life. Fuck it, I want to drive a Rolls Royce, I want to have a diamond Rolex, etc. But never so it would affect my investment portfolio or my living situation. That's not the case on Instagram. On Instagram, literally people are chasing the payment and hoping they can make it through the next month. Stop looking up to that. It's a death trap. Step number 6 is emotional decision making in markets. Average investors buy when excited and sell when scared. Disciplined investors do the exact opposite. They treat volatility as the opportunity, not a threat. Emotional reactivity destroys returns. Exactly as Warren Buffett was saying. Buy when people are scared and sell when people are excited. You do the exact opposite. So what I do, when there's an investment that I like, it has to be at the bottom or close to the bottom, and I buy it and I never sell it. This has turned out to be the best investment strategy I ever made. I don't sell, I don't need to take the profits away. I'm 32 years old, I can make money to support my lifestyle. I don't have to take money from my investments. Reinvest, reinvest, reinvest. I will probably transfer dividends to my account maybe when I'm 65 or 60, okay? But before that, I will reinvest everything and I will keep working hard so I can provide for myself and for my family, of course. Emotional decisions are where people fall on their face. They get excited from the news, from social media posts, this and that stock is dropping the price, and they don't understand that the price of the stock literally doesn't have to have anything to do with the health of the company. The price of the stock could be literally just destroyed or inflated or dropped purposely by the media. People get scared, they sell, the price drops. Then they want to inflate the price. They will make the stock sound popular, everybody jumps in, and the price will go up. When you look at the company and the balance sheets, etc., the company has a healthy cash flow. They're not in a big debt. They're doing great, but at the same time, the stock price goes up and down, up and down, up and down. It's ridiculously jumping. So the stock price and the company health are two separate things. But people are selling themselves emotionally on the stock prices and the news, right? You don't really have to be an Einstein. You just look at the stock price, you look at the balance sheet of the company, you ChatGPT the health of the company, it's a public record, you have access to it, and you realize, oh, the company is doing good. When the stock is down, I'll just buy more. It doesn't mean they're going broke. So don't be emotional. Just buy things that you believe that are going to be here for 30 years plus. You should be always able to explain your investment to a 5-year-old and buy it when it's at the bottom. That's it. Number 7 is lack of rational discipline. True wealth building requires consistency, patience, rational analysis, ignoring crowd behavior. Most people prefer comfort, entertainment, and social approval over delayed rewards. Wealth, however, rewards those willing to look wrong in the short term to be right in the long term. What does this mean? Building wealth is boring. Boring as hell, I'm telling you. For the first decade, it doesn't even look like you're getting anywhere. You put in $100, $200, $500, $1,000 here and there, whatever you got spare, you put it into the investments, looking for opportunities. If there's no opportunity, you just put the money in a money market. You let it sit there at the 4% interest. It's generating more and more income for you on a monthly basis. And then once when the opportunity pops, you sell the cash from the money market and you buy the opportunity. That takes consistency, and it's boring. However, I'm telling you, like I was told by the richer, wiser guys than I was, it works. After the first decade, when you look at your account, it's definitely going to be your biggest account that you own. From all the bank accounts or whatever accounts you have, that one investment account where you constantly put money in to your brokerage is going to be the biggest one. So the consistency, patience, and rational analysis always wins. It's boring as hell. Stop looking up to people who are blowing the money away. Start looking up to people who are actually making wealth. One of the best guys that I love is really Warren Buffett and Charlie Munger, because they're going to make you feel like you can get there too. Maybe not to their level, but you can get at least out of that shithole where you constantly have to work and chase your tail for the bills. You can get out of it. You don't have to make millions for it. You just have to make the gap between the expenses and the income. That's it for today's live stream, beautiful people. Please